Hey everyone, and welcome to The Explainer. Today we are putting on the ultimate liquidity lens to decode corporate financial health. We're unpacking one of the absolutely most vital, yet let's be honest, frequently misunderstood tools in all of financial analysis, the cash flow statement. By the end of our time together, you're going to see exactly how this document cuts right through all the accounting noise to reveal the true beating heart of an enterprise. Let's dive in. We have to start with the ultimate business paradox. Picture this, a company reports a massive net profit on paper, everyone's celebrating, but then they still run out of actual money to pay their bills. Wait, how is that even possible? Well, an income statement shows what an enterprise earned over a given period, but it includes non-cash items and accrued revenues that literally haven't hit the bank account yet. And that right there is exactly why we need a dedicated statement to track the pure, actual movement of cash. So, here is our roadmap for demystifying this document today. 1. Introduction to cash flows. 2. Classifying business activities. 3. Decoding operating activities. 4. Investing and financing explained. 5. The indirect method. And finally, 6. Why cash flow matters.
All right, Section 1, Introduction to Cash Flows, beyond the income statement. Let's start with the absolute foundation and define what exactly we're measuring when we talk about cash.
You see, we aren't just talking about stacks of physical cash sitting in a bank vault or a register. We're also talking about what we call cash equivalents. According to the accounting standards, these are short-term, highly liquid investments that can be readily converted into a known amount of cash with almost zero risk of their value changing. The golden rule of thumb here, they've got to have a short maturity of 3 months or less from the date of acquisition. Think short-term marketable securities. And tracking this liquidity? Yeah, it isn't optional. For companies operating under the Companies Act 2013, preparing a cash flow statement is strictly mandatory, and you've got to do it in accordance with Accounting Standard 3, or AS3 for short. The law actually specifies that if these standards aren't followed, your financial statements won't be considered true and fair. So this is a heavily regulated, legally required deep dive into a company's health.
Moving right along to Section 2, Classifying Business Activities, the 3 engines.
To make sense of all this, AS3 says you can't just throw all your cash inflows and outflows into one giant confusing pile. You have to tell a story about where that cash is coming from by categorizing the enterprise into 3 primary engines: operating, investing, and financing activities. By sorting every single dollar into one of these 3 buckets, anyone reading the statement can clearly assess what's really driving the financial position of the business.
Let's look at the first one. Section 3, Decoding Operating Activities, the revenue engine.
If a business were a living organism, these operating activities would be its heartbeat. This is the day-to-day revenue-generating lifeblood of the whole operation. We're tracking the primary activities here. So inflows, like cash from your customers, royalties and commissions, directly weighed against outflows like paying your employees, buying inventory from suppliers, and covering everyday expenses.
Why is this so crucial? Because your operating cash flow acts as the primary gauge of internal solvency. It basically proves whether a company can survive organically. If your daily operations consistently generate enough cash, you can keep the lights on, pay dividends, make new investments, and pay back loans, all without having to go out and beg for outside funding. It's truly the ultimate litmus test for whether a business model actually works.
Okay, let's zoom out a bit. Section 4, Investing and Financing Explained, Assets and Capital. A business doesn't just operate day to day, it has to build for the future and manage its investors, right? That's where the other 2 engines come in. Investing activities show you what long-term assets the company is buying or selling, like property, plant, equipment, or non-current investments. Financing activities, on the flip side, show where your overarching funding actually comes from. They deal with changes in the owner's capital and the company's long-term borrowings. Let's look at some concrete examples directly from the source material to make this super clear. Selling an old piece of machinery? That's an investing inflow. Purchasing non-current investments? Investing outflow. Now contrast that with financing. If you issue new equity shares to raise capital, that is a financing inflow. And here's an interesting one. Notice how paying a dividend to your shareholders counts as a financing outflow. This structure perfectly separates what the company owns from how the company is funded. Now, what if something completely wild happens? Say an earthquake destroys a warehouse or there's a massive theft. These are what we call extraordinary items. The rules say you absolutely must separate these out. By disclosing these freak, non-recurring events separately, whether they're operating, investing, or financing flows, we make sure they don't skew the normal year-over-year analysis of what the business can actually do. All right, time for some math. Section 5, the indirect method, working backward. How do we actually calculate that all-important operating cash flow? Well, while there is a direct method, AS3 frequently uses this really fascinating procedural framework called the indirect method. And honestly, it kind of feels like working backward. We actually start the whole process with net profit before tax and extraordinary items. But wait, didn't we just say profit isn't cash? We did. But the income statement is a great starting line. We just have to strip away all the non-cash illusions that accrual accounting put into it.
Here's the brilliant logic of how we do that. Step 1. Start with that net profit before tax. Step 2. Add back your non-cash items. Take depreciation, for example. It lowers your net profit on paper, but you didn't actually write a physical check for depreciation this year, right? So you add that money right back. You also reverse out non-operating items like interest or dividends received. Step 3. Adjust for changes in your working capital. And finally, Step 4. Deduct the actual income tax you paid. Boom, you've got your net cash from operations.
Now, step 3, working capital, is usually the trickiest conceptual part. It can feel pretty counterintuitive at first. Let's say your current assets, like inventory, go up. Well, you had to spend actual cash to buy those goods, right? So an increase in a current asset actually drains your cash, meaning you must deduct it from your profit. On the flip side, if your current liabilities, like accounts payable, increase, it means you're holding on to your cash a little longer instead of paying your suppliers right away, so you add that increase back. It's an incredibly smart system of checks and balances.
Which brings us to our final stop, Section 6, Why Cash Flow Matters, the Ultimate Truth.
Bring this all together, why do we go through all this rigorous, highly regulated accounting? Why do analysts and investors obsess over this one statement? Because it cuts right through the noise. It evaluates a company's true liquidity and solvency. Can they pay their debts today? It enhances comparability across different businesses because it strips out the effects of different accounting treatments. It acts as a massive reality check on past assessments. And most importantly, it forces us to look at the actual relationship between the shiny profitability claimed on the income statement and the cold, hard cash actually moving through the bank.
At the end of the day, a balance sheet shows what you own. An income statement shows what you earned, on paper. But can your business actually pay its bills tomorrow? The cash flow statement is literally the only document that can answer that critical question. Where did the cash come from and where did it go? So the next time you see a company bragging in the headlines about record profits, ask yourself, is the cash actually in the bank, or is it just a clever accounting illusion?